Okay, so welcome to this module on how to remove your emotions from trading. This is a real linchpin to your long-term success as a financial markets trader. Emotions rule the markets and they'll ultimately rule your trading decisions as well. So if we can keep them under control and be relatively unemotional when it comes to trading, then we really have come a long way and we'll be head and shoulders above a lot of the people who you'll be trading against in the market in terms of retail traders. So how does trading make you feel? A lot of people, when they're new to the markets, probably go through all of these emotions, having won a bit and lost a little bit more. There's the all-encompassing fear of losing, fear of winning, having an emotional attachment to the outcome of the situation, and this feeling of entitlement, of course. You might feel that, hey, I've bought a course and I've scanned through the markets and I've learnt a strategy, then the market better damn well give me a setup. So you feel that little bit more entitled and that you should be placing a trade no matter what, even if the market doesn't give you a setup based on your strategy. And that causes a whole lineup of bad habits. Trading out of boredom, you lose money, then trading out of revenge, of course you'll lose money, and then the final hit is when you trade out of anger, when you're trying to make back the two previous losses, only to lose even more. That's a vicious cycle which a lot of people fall into when they don't know what they don't know. So people who have yet to cut their teeth in trading generally are doubtful of their own ability. Can I really do this? Does this strategy really work? Can I make it work? Goodness, how long have I got till I become a full-time consistent trader? All right, but generally people who are new to the markets, who haven't really paid their dues, so to say, become angry and frustrated if they are not willing to essentially take action in terms of rectifying not only their strategy, but their approach in terms of psychology as well. Okay, so these bad emotions, fear of losing, fear of winning, becoming attached to the outcome and entitled, essentially causes anyone, myself included back in the day, to self-sabotage and just take trades for the sake of taking trades, even if they don't fulfill rules. You cut your winning trades short too early, even if they're making a nice profit. It's that classic textbook scenario where you might have endured a few losing trades, and then that one trade where you make a bit of profit, you think, goodness, wow, I'm going to cut this trade early to make that tiny bit of profit, only to your horror to watch the market completely go in your direction. That is a very common scenario which a lot of people find themselves in, myself included. But of course, despite that small win, which doesn't even make one losing trade back in terms of remedying the loss, you'll be taking full hits from your losing trades. And it's a very common scenario where I have, for example, a client who's got this wonderful profit and loss statement where they've got more winning trades than losing trades, but under closer examination you see that the winning trades are tiny in their wins, but the losses are enormous by comparison, even if they're trade sizing. And that's a typical example of someone who will take a full hit if the market goes against them, i.e. losing 1 to 2% of their trading account, even if they're risk managing. But when they see that tiny bit of profit on the table, they'll take it out of fear of losing it and it turning into a loss. And this is where people generally grind their account down and die by 1,000 paper cuts. Again, this causes the rookies certainly to get even more angry and frustrated. Okay, but trading doesn't have to be like this at all. Trading, certainly in our humble opinion, should make you feel calm and patient. You should be confident in your strategy. You should not have an emotional attachment to the outcome of the situation or indeed the market. An appreciation that the market could do anything at any time should be enhanced or embraced, should I say. The market doesn't owe us just for turning up. We might be the best trader, have the best kind of like appreciation for the strategy and execution of the rules or implementation of the rules, but it still doesn't mean that the market doesn't owe us for this. The market will just do its own thing no matter what. Okay, you should be optimistic that when you're right, you'll win big, but when you're wrong, you should lose small. And accept that losses are part and parcel of trading. That's very important. No strategy wins all the time. Some strategies win some of the time. Some strategies yield setups which trade most of the time, but no strategy wins all the time. And this is why I'm a fan of setups with low probability, high reward, because they generally have and far higher profit potential over the long term, rather than those high probability trades which essentially have inverse reward to risk. When you lose a high probability trade setup, you generally endure a full hit of 1 to 2%, no matter how, regardless of how much you risk on that trade. Whereas if you win, generally the reward is a lot smaller than what you risked. Okay, so how you should feel should cause you to only trade setups that fulfill your rules, and for you to accept that anything can happen at any time, no matter what, and appreciate the frequency of trades, setups at random, not to mention winning and losing trades. It's one thing to have a completely disproportionate frequency of trade setups, but it's a whole different kettle of fish to have winning and losing outcomes. Okay, your strategy should cause you to win big and lose small, make money over the long term, and essentially just use trading as a supplementary income, and for it to be a peaceful and relaxing activity and to neatly fit in the background. Okay, but how is all this possible? Well, it is possible, and I know a lot of people who are nursing the battle scars of trading. Trust me, I've been through it, and I've made every single mistake in the book several times over. Like I mentioned, it's very simple. You need to separate your head from your heart, and this is where you engage the logical mind. The problem is that where there's money involved in the picture, people get emotionally involved, because of course to many, money represents scarcity. It's a scarce commodity. Money represents labor, it represents effort and investment into getting that money, whether it's time, whether it's going to work, whether it's swapping time for money, something like that. So this is why it's scarce, and this is why people generally have an emotional attachment to it. This is why I always recommend to people, never trade with money that you can't afford to lose. That's very important, because if you're in that position where you've got a trading account where it's funded by money you can't afford to lose, then essentially you'll have no emotional attachment to your trading. And not to say that's fine where you can punt, where you've just got a trading account where you can do whatever you want to it. I'm simply saying it will take away that stomach churning emotion of fear and greed when the market's going against you versus when it's going in your favor. Okay, so here is a simple framework for you to use. Okay, and I want you to write all these down if you can, if you have a pen and paper. Okay, it's absolutely essential to have realistic expectations from trading. It's not a get-rich-quick scheme. If you're looking for consistent incremental gains over a relatively medium, long-term period of time, then great. If you're looking to double your account in a month or even 6 months, I would suggest trying something else and not trading. Never ever traded money that you cannot afford to lose. That's what I just mentioned, and that's absolutely essential. And in the same kind of bracket as that is, you should trade size and never risk more than 1 to 2% of your account's value, no matter how big your account is or isn't. Okay, whether you've got a tiny account, whether you've got an enormous whale of an account, you should never risk more than 1 to 2% of your trading account, because this is a good habit. Sometimes even the best setups you will ever see turn to dust and lose money, and this is why there's no such thing in the market as a dead cert, or a trade that's guaranteed. The market will be completely random in how it moves and how the outcome comes to fruition. Always trade setups with positive reward to risk. So if you're risking 1% or 2% of your trading account, you should ultimately target a trade or place a trade where you can essentially win double what you've risked. Always use a protective stop loss. Like I've said, there's no guarantees that the market can go in your favor. If it does, then you need to be prepared for it. So use a protective stop loss so that your broker gets you out of the trade if it does, so that you're not hemorrhaging money in your trading account. And always let your winners run every time. Don't exit a winning trade too early. That's because if you're riding a wave and the wave is a big wave, it makes abundant sense for you to simply carry on riding it until the wave's finished. A lot of people, myself included back in the day, would simply kill a winning trade prematurely to bank that profit when actually the market has a lot more leverage in it and a lot more mileage to go. Okay, so when you're in a big winning trade and you think you've hit target, instead of killing the trade completely, scale out of the position. Say if you're long and you've bought a pullback, buying the dip in an upward trend, rather than killing the position, say for example when it's got the previous swing high, scale out of the position where you've essentially sold half the position, you've banked half the profits and left the remaining half to run. So the above point's pretty obvious, and I know a lot of you probably thinking to yourself, hey, I've had this all before, whatever, but a lot of people still fail to do this. And if you just make a sketch or make a note of the steps above, it really will help to remove the pressure on both your trading, remove the emotional attachment to your money and the outcome of the trade, and of course your egotistical attachment to the strategy. Okay, regardless of whether you're trading a real live funded account or a demo account, you're always going to have a degree of egotistical attachment to the strategy because you've invested your time and patience into it, and you're invested in it emotionally. Okay. So how does this work in practice? Well, it's quite straightforward, and one of the key elements to this is having realistic expectations. If you're looking for a get-rich-quick scheme, then I would advise you to go on and move and find something else. The market does not owe us anything for just simply turning up. Time does not equal money in trading. You can make more money from trading a setup that takes 3 minutes to trade, and you could just leave it for weeks, months at a time, than you would for a trade strategy which requires hours monitoring. Okay, that's a beautiful thing about trading. It's a completely disproportionate relationship between the time spent in front of the screen looking for trades and trading trades versus the money you could potentially make from them. The number of strategies you trade does not equal more money, and of course the more trades you place does not equal more money either. Admitting defeat and accepting that loss is all part and parcel of trading in pursuit of winning the overall long-term war, that's absolutely essential. And just on that note, just acknowledge that slow and consistent gains can be made over time if you have the right edge, a winning strategy with rules for entry, management, and of course exits. Know what to trade and when to trade it, but crucially, know what not to trade. Only trade what you see, not what you think. Risk management, this is absolutely essential. Again, this is huge. A lot of people don't get this, and they don't want to get this because they want trading to be fun and they want to risk the house in their trading accounts and of course talk about their winning trades if they're right, and conveniently forget about their losing trades if they're wrong. We need to really look at our trading account as a business and never trade with money that we can afford to lose. Okay, with whatever money we do have in our trading account, we should treat like a business. Our first ulterior motive as a trader is to essentially break even. Our second objective is to make money. A lot of people would say 92% of the market crash and burn. I actually, a few years ago, got into a conversation with a broker who said, I think he had a bit to drink, quite frankly. I'm not going to reveal the brokerage or the name of the person, but he basically boasted that 90% of his clients lose 90% of their money in 90 days, which is an absolute staggering, shocking statistic. And through just employing risk management, that will certainly keep you head and shoulders above the cattle, the cannon fodder in this. So we say risk no more than 1 or 2% of your trading account per trade, no matter how good the trade looks, because it will enable you to keep in the game for longer, regardless of whether your strategy is a winning or a loss-making strategy. Okay, it will buy you time, but when you do tweak your strategy or find a winning strategy. But remember, like I mentioned earlier, winning trades and trade setups are disproportionate in their frequency. Just like buses turning up in London, you could be waiting for days if you're an end-of-day trader, or even weeks for a trade setup. At this moment in time, the last trade we placed was about 3 weeks ago. It was a break-even trade. And the trade before that was about 6 weeks ago. That trade setup is up about 20% rolling profit at the moment, risking 2% of our trading account. So that's absolutely fine. That's ticking away in the background. And if we haven't had any bona fide setups to trade in the meantime, that's fine, because it means that we are preserving capital in the meantime. And like I mentioned, preserving our capital is our first objective as a financial markets trader. Our second objective is to make money. Okay, so 1% per trade. I'm pretty sure a number of you get this, or most of you get this. 1% of whatever you're trading, so £1,000 or dollars, you should never risk more than £10. If you're trading 100,000, never risk more than £1,000 per trade, no matter how good the setup looks. Okay, we can always apply this formula. So 1% of your trading account divided by the difference between our entry and our stop loss, which will equal, if you're a spread better, the amount per pip or point if you're trading something outside of currencies. So let's take this example here. We've got £500, and then we've got 9483, take away 9392, and divide the answer, or 500 by the answer, giving you £5.49 per pip. Okay, so always use a stop loss. You would never go bungee jumping without a cord. You'd never go driving without a car with 4 wheels. You might as well use a protective stop loss, which will get you out of the setup if it goes against you. Remember, stop losses aren't there to ruin your fund, they're there to protect you. And a lot of brokers will have this facility in place. They won't necessarily encourage you to use a stop loss, especially if they're a B-book broker. B-book brokers, by the way, are brokerage houses who take the other side of your trade. They're not direct market access like A-book brokers. B-book brokers are the ones who essentially, when you make a loss, they make money from you. If you make a win, they make a loss. So they're the ones who have a vested interest in you losing. And like I mentioned, 92% of people who do try their hand at trading do fail. So in terms of a business model, being a B-book broker is actually a fantastic way to make money from a raw capitalistic standpoint. So you need to protect yourself and use a stop loss, because it will play a pivotal role in getting you out of the trade if it moves against you. Remember, stop losses should only be placed at a point where if the market reaches it, then the trade setup is invalid anyway. Okay, so like I mentioned, they're not there to ruin your fund, they're there to protect you and to prevent you from ultimately wiping out your trading account. Okay, trading strategies with positive reward. Again, this is pretty important, because it means that if you lose small, but if you win big. This is the lifeblood for trading, certainly on the daily and the weekly time frames, and this is a style of trading which we trade because we like to set our trades up and walk away. We don't like to be monitoring our trades every 5 minutes. That's not why we chose trading. We chose trading to fit into our lifestyle rather than have to fit our lifestyle into trading. That's the crucial difference. So like I mentioned, 1% to 2% is what we place on the trades, but we look for a 3-to-1 reward to risk, which means that we're always looking to make 3 times what we're potentially risking. Alright, so where there's risk, there's reward, and the bigger the reward potential, the lower the probability. Okay, so here we are. Remember, the higher the probability, the lower the reward. The higher the reward, the lower the probability. It's that simple correlation there. As I touched on earlier, I'd far rather trade a strategy which has low probability, because I know that when in the save it's like a 30% probability, I know that the reward potential on the ones which come through are going to be pretty staggering. Whereas if I'm trading a strategy which has a high probability but a tiny reward, inverse reward to risk, say you stand to make a reward potential of like 1/3% or 0.5%, risking 1%, and it has say an 80% probability rate over a certain amount of time, all it takes is for a change in market conditions to drastically alter that, and for you therefore to really hemorrhage your trading account, and that can really cause a lot of blood in this respect. Versus if, for example, your low probability strategy of high reward, if there's alteration in the market conditions, when I say alterations, if the market changes in its conditions, then if it moves up in probability, then that's going to have a fantastic appreciation to the equity curve. All right. But a lot of people, when they're finding reward and ultimately looking for exit points of their position, they mix up what is realistic versus what they want to happen. So it's always important to choose exit points within the realms of probability rather than just what you want to happen. Remember, the market doesn't care about you and what you want to happen. It will do its thing regardless. Okay, there are millions of people partaking in the market. This is why there's no such thing as a dead cert, because there's always going to be someone else out there who's going to be taking the other side of your trade or embraces the opposing view to you. Okay, and as technical traders, we just simply look at past price action to really give us clues as to what is going to happen next. Okay, so in order to find the reward risk equation, it's quite straightforward. All we need to do is find entry price, take away our target price where we think the market is likely to go, divided by the difference between our entry price and our stop price. Okay, so in this worked example here, say our entry is 97.53 and our target is 95.75. Say if we're going short in this example, yet our entry price 97.53, take away our stop price 97.98, gives us 45 pips. So 170 pips profit potential we're looking to make divided by the risk of 45 pips gives us a 3.9 to 1 reward to risk trade. That's worth taking, because you know full well that if the market goes against us, we lose 1 or 2% of our trading account depending on how much we risked. If it goes against us, then that's just unfortunate. It's part and parcel of trading. But if it goes in our favor, then we know we've made 3.9%, or if you're risking 2%, times that by 2, and that's a very nice little gain you've made potentially. Okay, so let's look at this example here. We've got euro sterling. This is a more recent trade we've taken last year. We had this inverse hanging man or bearish pin bar reversal, whatever you like to call it, with our entry just below the low, stop loss above the high, risking 67 pips, target 246 pips, and that really gave us a reward to risk which was worth taking, 3.6 to 1. Okay, so we took that because we knew, okay, if we risked 1%, we'd lose 1% of our trading account because we would have trade sized it. However, if we'd gained, we would make a 3.6% potential return on our trading account. So if we put this into context, if we're risking 1% of a £10,000 trading account, or $10,000 for that matter, if we lose $100, if the trade goes against us, that's 1%, but if the trade goes in our favor, we stand to make 360 if the trade goes and hits target. In this example, this coincided with the general election 2015 in Great Britain, where the Conservatives ultimately won. And what happened here is we had a bullish pin bar reversal, and we had a simple opportunity of buying the dip in a prevailing upward trend. Our entry just above the high, plus spread, plus an additional pip with our stop loss just below the low, meant that we were risking 186 pips in an opportunity which could have gained us 338 pips from targeting the previous swing high in an upward trend, making higher highs and higher lows. Now, the previous higher high is generally the first point where we look to take profit, and it's generally where we look to gauge our initial reward potential. So 838 pips potential reward divided by 186 means that we've got 4.5 to 1 reward to risk. Okay, so on a $10,000 or pound trading account, that means that if we lost this trading opportunity, it means that we've lost only $100 or £100. However, if the trade does go and hit our first target 1, the previous swing high, then we could stand to make $450 or pounds, depending on what currency your trading account is in. And this is just target 1, by the way. Remember with what I was discussing about not killing a trade which is essentially going in your direction. The previous swing high generally represents the point where we look to scale out of the position by selling, in this case, half of our long position, leaving half the position to run to target 2, which is a new swing high, and banking half as well. Okay, so this is just to give you an idea of high reward potential trade setup, where If we risk 1%, then we only lose small if it goes against us, but if it goes in our favour, then we stand to win big. And this is why we trade setups with high profit potential. Your recipe for success is to be realistic and to be fair to yourself. Embrace a profitable strategy, trade with money that you can afford to lose, keep the risk small, use a protective stop, and trade with positive reward to risk. As you'll find, if you trade with positive reward to risk, you still make an over profit, even if you have more losing trades. That's the crucial thing. By embracing the above, it will cause you to be patient and calm. It will transform what is experienced by a lot of people as a time-consuming, loss-making hobby into a profitable activity. It will make sure that you're non-outcome attached and embracing the fact that the market could do anything, and optimistic that if you're right, then you're rewarded handsomely for it, and appreciative that losses are part and parcel of trading. By keeping the losses small and the wins big, you have the potential to do very well long term.